Hello, Mark Sturdy here with highlights of 7 Days Ahead's multi-asset technical strategies, week of the 23rd of November 2021. Turning to the summary, in the currencies, we are very aware that the dollar has been strong and we think it's going to get a lot stronger, in particular against the euro, and so we're out and out bearish of the euro in all time frames. And the important chart there is the weekly with a double-headed head and shoulders reversal, driving the market on down, we think, as far as 110. We're also bearish of sterling, but slightly less so. Might be some support here in this monthly neckline, but short term it has broken this 134.82 level, which we think was important and coincided with a diagonal here. But as you can see from the very short-term daily chart, there is some reluctance to go for sterling to weaken a great deal further quickly. So we are more bearish of the euro than the sterling. The result of that is, of course, in sterling-euro, sterling's strengthened against the euro in the cross. But until this market can break out of this well-established, extremely well-established trading range over the last 6 years, since 2016, we find it difficult to get very excited about the sterling-euro. The yen, we have a long-established position of being short the yen in the very long term and the medium term. However, in the short term, that is to say since mid-October, the market's gone nothing but sideways, and so there's nothing doing there. As regards stocks, yeah, we're out and out bullish of S&P 500. It is a tremendous performer, and we think it is the market, after the recent setbacks of mid-November, it's the market closest to breaking into new ground, just teetering on the prior high before it pushes on ahead. And when it breaks that, we think there'll be a new bull leg. The Eurostoxx 50 and the FTSE, while they remain bullish, let's look at the FTSE. While this is bullish, we think this is a bull triangle. There has been hesitation at this falling diagonal, and whereas the S&P has managed to bounce back swiftly, there's been much more of a retracement and stodgy performance by, for example, the FTSE here. Interesting to watch how the FTSE performs with this support, prior high support here around 7160, 7154. Until that breaks, though, we still remain bullish and we still think it's a good bull market, as is the Eurostoxx 50. The Nikkei 225 is rather different. We're long-standing bulls of the Nikkei 225. We think it goes a lot higher, but it's been stuck in this weekly trading range for a long time, since the beginning of the year. So until it can break that, it's difficult to get excited. Sure enough, the market has bounced back up from 27,000 in early October, but until it can break out of this whole trading range, we're standing back. Bonds are complicated. We're standing back from all of them. And I will focus, for the purposes of this highlight chit-chat, I'm going to focus on the gilt, because that was the one we were strongest for higher yields. And the important move there is, notwithstanding the fact that it's broken up, we thought in the very long-term chart, through this long-term diagonal, we thought there was in the yield chart, there was a head and shoulders reversal. But such has been the power of the retracement, it's gone through the neckline and to sitting on this long-term diagonal. It looks pretty bad. It's pretty uncertain. The yield bears, that's to say for higher yield, or the price bears, will note that the market's bounced up and has a 61.8 retracement of the whole bear price move, which is the rise in yield since August, and might use this as a critical moment to see whether this is resistance in price terms. In short, be very careful. We think there is a big threat to the plausibility of the rising yield thing that's entered the market, but you might want to use this Fibonacci resistance as an important level to watch. Oil and gold. Oil has pulled back sharply, and let's have a look at that. It hasn't broken down in the monthly continuation chart yet, but the medium term has. and that's very unhappy. We thought this was a Head and Shoulders bottom. We thought that 76.90 might be good support, but it's broken down through both of them. It hasn't broken down totally in the December chart. It hasn't broken 72.61, although it has gone further since this chart was recorded. But it's under pressure. We would take our watch carefully the 72.61 levels to see if they can hold. Gold. When I wrote this, we remained bullish because the market had remained above this triangle, even though it had pulled back. It has come back further down through this horizontal, so the December contract, the weekly contract in December, looks a lot worse now. This has been broken down beneath. So whereas we were out and out bullish, I think looking at it today, you'd be much more cautious of gold very short term. Thanks very much.